Hey guys, this is Nick from Financially Aware, and in this video I want to talk about the commercial real estate market and the huge jump in the delinquency rate for May 2020. And a lot of people may not think that it matters. They don't really care about the commercial real estate market, but it will also eventually affect the residential real estate market and also real estate investment trusts. So if you're thinking of investing in residential real estate, commercial real estate, or just the REITs, this video might shed some light on if we are closer to the bottom or still closer to the top in the real estate markets and what could affect it going forward. So here we see that the percentage of CMBS, which is commercial mortgage-backed securities, which are basically bonds that own a bunch of commercial mortgages and usually in different sectors. So there might be one bond that has residential real estate mortgages in it, another bond that has retail mortgages in it, that kind of thing. So here you see that the percentage of CMBS marked 30 days delinquent or more jumped from an average, bumping around 2% to 7.15% from April, which was just 2.29. That's a huge jump, and that's the largest monthly jump ever since they started tracking this thing in 2009. Now, not everything is bad for commercial real estate. Different sectors are faring differently. So you see that the industrial sector is doing fine. I mean, 12 months ago, it was 2%. That was 30 plus more days delinquent. Now it's 1.82. Multifamily is only 3.25. Compared to 2.16, office is 2.4, doing even better than 12 months ago, but worse than the last few months. But the two glaring, obvious, really bad ones are lodging, which is like hotels and stuff. 12 months ago, it was at 1.42%. Delinquency rate of 30 plus days. Now it's 19.13%. And of course, retail, which 12 months ago was 4.29, and now it's 10.14. And just to give you an idea of what's going on in retail, I don't know if many people know this, but the US retail space per capita is huge compared to the whole rest of the world. So, meaning retail space per every person in the US is 23.5 square feet. The next biggest one is Canada, which is 16.8, and then Australia, which is 11.2, and then Japan and a lot of European countries. So we're about 50% bigger than the next biggest one, Canada, and more than double the second biggest one, Australia, and then we're like 4 or 5 times most of Europe and every place else. So what that means is that we have a lot of extra retail space, and if they're not paying their mortgages now, there could be a lot of empty retail stores and space, especially with the headwinds of online retail sales, advancing every year. This could be kind of a perfect storm for retail, commercial mortgages and commercial buildings and any kind of retail locations. So what does this mean for real estate, both commercial and residential? Well, a lot of people want to be optimistic, but somebody who I consider, and most people consider to be an expert on real estate, known as the godfather of modern real estate, they say, and owns or is the chairman of one of the biggest residential REITs in the country, EQR. That would be Sam Zell. And in this Bloomberg interview, you see he's not very optimistic about what's going to happen going forward.
Sam, what do you think is the greatest misconception many people are under right now as they look into this uncertain future?
I think that too many people are anticipating a kind of V-like recovery. We've been through this terrible period. The period's going to end. The virus numbers are going to go down, and the world is going to go back to normal. And that's why, your opening question to me, I answered you by saying I think it's going to take quite a while, and that it's not going to be easy to, quote, return back to where we were.
Well, you've been warning that there's been too much construction in U.S. real estate. There was a tsunami of oversupply. Here we are now. How do you think that's going to affect the market? Where are the winners and losers going to be sector by sector?
Well, I guess I'd start by identifying the obvious. I think probably the number one victim is going to be retail. And our retail was already feeling the effect of e-commerce. Now you've added e-commerce and density, and I think there's very little doubt that in the end we already had a very significant oversupply in retail. So I would think that retail is probably going to take the biggest hit. The second biggest hit is going to be hospitality. Again, we've built a lot of hotels in the last 5 years, and we were already beginning to see oversupply affecting RevPAR and affecting occupancy. Unquestionably, this is going to dramatically make things much worse, and I would at all be surprised if just like we won't see a lot of retailers reopen, I don't think we'll see a lot of hotels. I think we'll see a lot of hotels that basically can't reopen. I mean, generally speaking, everybody has been focused on when is this, going to end. Nobody's really been focused on the question of what does it cost to reopen.
So there seems to be a big disconnect between what's going on in some parts of the economy and other parts. For instance, we have super high unemployment, approaching 40 million people unemployed, reaching Great Depression levels. So many businesses are still closed down, and yet we see things like the stock market, the S&P 500 is above 3,000. The NASDAQ 100 is almost at all-time highs. And even the REIT ETF VNQ has bounced back significantly from its lows. Also, car sales have bounced back, even though so many people are unemployed, and I see so many comments about how car dealers aren't lowering prices, whether they're new cars or used cars. So what can you make of this? I mean, on the one hand, so many people are unemployed, so many businesses are closed, so many companies can't pay or aren't paying their rent and their mortgages, and yet the stock market is booming up. Car sales, the prices haven't dropped yet or anything. Real estate prices haven't dropped yet because of residential owners of real estate have forbearances that they can do for 6 months and another 6 months after that. So we really won't see any low prices in real estate until after those forbearances expire and the real estate market is laid bare to see who can pay their mortgage and who can't, especially if the unemployment rate stays at these huge levels going forward. And just to give you an idea of how the unemployment rate is tied to bankruptcy filings, meaning companies that can't operate anymore under their current condition and need protection from the courts and their creditors. Take a look at this. This is the unemployment rate from 1995 in red, in blue, and this is the total Chapter 11 bankruptcy filings in red. So you see that when unemployment spikes, bankruptcies spike also. And here in the financial crisis 2009, they both spiked together. And now here we are. We had low unemployment rate, but now we've spiked up to 18% or more, some say, depending on how you count it. And yet the Chapter 11 bankruptcy filings are still very low. So what you can expect is that these things are going to shoot up to a level that it's got to be bigger than the financial crisis here, because the unemployment rate is way higher. So with that said, there's going to be a lot more people unemployed, or at least these people are going to have a hard time finding a job, and therefore they're going to have a hard time paying their bills, paying their car payments, buying new cars, buying even used cars going forward. And real estate is usually the last thing to fall, because it takes so long from the time people stop paying a mortgage to the time they go to court, to the time they get foreclosed on, to the time that thing gets sold. So this is just the early innings of all the damage from this shutdown and the unemployment and everything. And and even lately the whole protests and stuff is not helping either, because a lot of businesses maybe are staying closed or something like that. So I mean, this is like a perfect storm. And if you're thinking of buying residential real estate, I would think if you're planning long term, you might want to wait a year or so and wait for this stuff to cycle through the system to see a lot lower prices, because I think we're going to be seeing that in residential and commercial, especially in the real estate parts of retail and hospitality especially. So that's my video on commercial real estate market and the huge jump in delinquencies and what we can expect going forward in the real estate markets, both residential, commercial, and REITs. If you like this video, give me a thumbs up, leave me a comment, and subscribe. Thanks for watching.